Larry Summers says the risks facing our economy are like those that faced us in the summer of 2007, calling for increased anxiety being justified as we potentially walk into a 2008, and we thought the worst was already behind us. Can it go lower? Yes. Is it going lower? Yes. 90% of S&P 500 stocks today are declining. The NASDAQ just fell under its 200-day moving average. And in this video, we're going to discuss exactly why. What's going on? What's causing the carnage in the markets? And am I selling? Am I leaving? Am I flip-flopping? Or am I just here to remind you that if you want a free Bank of America stock, you can get a free Bank of America stock. All you have to do is click the link down below, right next to the link for the courses with a coupon code expiring Friday, or the link to sign up for House Hack, also with an expiration on Friday. All right, folks, let's get into what's happening. First, we're going to talk about the economy, then we're going to talk about the Fed, and we're going to talk about how to save this potential disaster, because everything relates to the Fed and its great reset that is worsening. But I want to start by touching on the actual economy, because this morning in my course member live stream, I asked course members, do you remember, and I want to ask the same of you, do you remember when back in January and February, I was called Mr. FUD for bringing up every earnings call that I could, showing how every single company was complaining, well, maybe not complaining, I should say bragging, about having a really big PP. That is a really big amount of purchasing power. Do you remember that? You remember me saying, look at all these companies talking about how they can raise prices to offset inflation because they have very large purchasing power. They've got large PP. Well, these PPs are now shrinking and instead are turning into a new form of PP called pricing pressure. Instead of pricing power, we're starting to see pricing pressure. Consider this. Wynn Resorts has seen a collapse of Chinese gambling revenue to the tune of 90%. And we're expected to stay at 90% declines, or so basically 10 to 11% of gambling revenue for Macau for the rest of the year. We're starting to see an earnings recession. China is just way ahead of us. But this isn't even a video about China. So I figured rather than just considering China, what can we do to look at some recent data that just came out at the start of earnings season, the afternoon of September 27th, and see how everyday America is actually starting to see the waning of pricing pressure. Well, I did nothing other than going directly to the earnings report for Cracker Barrel. Yes, I kid you not. I went to the Cracker Barrel earnings report and we went through it with course members this morning to understand what's happening to folks. And there are a few reasons for that. First of all, boomers and matures own a lot of real estate. In fact, they own real estate at twice the rate of millennials. And boomers and matures, they use that word, okay? It's really weird. I highlighted it in yellow there, okay? That's theirs. Boomers and matures apparently are holding back visits to even Cracker Barrel. They're spending less money. And when boomers are spending less money at Cracker Barrel, you know we're starting to have the start to a bad earnings season here. But it's not just that. It's the shrinking of PP due to softer consumer demand, higher costs, and now, instead of talking about how much pricing power we could pass on, we have companies saying, hey, we're evaluating our cost recovery against the potential impact on the value perception and guest visitation. Okay, this is the kind of stuff that we talk about in the course member live streams. When we go deep, it's not just Cracker Barrel, okay? But when we go deep into companies and we actually see, we're starting to see a transition. And that's what we're starting to see in earnings reports and earnings call. A transition in the economy to one where we're worried about inflation for longer, where companies are telling us we don't actually see job inflation going down. If anything, we see wage inflation continuing to go up. And we still don't have certainty as to when inflation's gonna go down, but we're starting to see demand go down. It's a trifecta of hell, okay? Higher wages, higher prices, lower earnings. So in case you're wondering why stonks are going down, you need to look no further than Cracker Barrel. But the good news is you can now get beer and wine at Cracker Barrel, and they say they are now all in on culinary innovation. And no, this is not sponsored by Cracker Barrel. Okay, but seriously, this is bad. And this is just the beginning of earnings season. Don't believe me? Look at what happened with CarMax today. CarMax is down 23% on what Bloomberg is calling a horrendous miss, wiping out over $2.3 billion in market cap. Like that. Could you imagine losing $2.3 billion? Like that? Q2 missed so bad. A lot of it is because of substantially low automotive consumer confidence right now. And in fact, I made a video just the other day about Tesla, and I talked about how we're suffering from potentially, or we're going to suffer from, a potentially dangerous recession in autos. I showed charts, I showed data about the recession that we're facing in autos and how this sort of pain is likely. And sure enough, here comes CarMax this morning warning about low consumer confidence. Their EPS came in at nearly half of the consensus at just 79 cents versus an expectation of $1.4, with comp sales down 6.3% year over year. It's bad. The earnings season is starting bad, and the stock market is preparing. But it's not just that. It's that at the same time as we're getting this bad news, you're getting folks over at the Fed laughing in our face. I kid you not, they're laughing at our face. You have people like Bullard, Mr. James Bullard of the Fed, saying things like, markets are finally making the right interpretation. They're implying they like the pain they're seeing. They're implying this is what needs to happen. Notice how every time we get a little bit of a bull rally, they come out more aggressive. They crush every single bull market recovery that we have in 2022. Every single time things start going up, they come out and start pooping on it to send things right back down because they're trying to destroy our wealth. When they destroy our wealth, we'll spend less money. When we spend less money, inflation will go down, and then our economic, our financial structures won't collapse. Kind of like what we're already starting to worry about in the 5th largest economy in the world, the United Kingdom. Watch my video this morning that I made where I break down how near collapse the United Kingdom actually was. Just crazy, absolutely crazy. We're not even talking about China here yet, which is the 2nd largest economy in the world. They're already in collapse. That's a complete disaster. But Bullard this morning says that markets are finally appreciating the fair amount of additional moves and interest rate hikes that we have to provide. And yesterday, Neil Kashkari from the Fed came out and said it would be a mistake to reduce too early, delaying prospects of a Fed U-turn. Markets this summer were pricing in this cherry-picked idea that we were going to have a U-turn in September. I covered it on the channel. I'm like, well, markets think we're going to have a U-turn in September. I don't know. Let's see. Hopefully we get inflation to come down. Otherwise, we're screwed. Inflation didn't come down. Inflation got worse. Not only did inflation get worse, and all essentially measures of inflation broadened, but now we're just getting truly hellish data out of countries like Germany. Germany expected 10.2% inflation this morning. They got 10.9%, almost 11% inflation, which is really bad for what the forecast is for the ECB. The forecast is 9.7. That'll probably come in at double digits too. At the same time, Chancellor Olaf Scholz set out a new $200 billion stimulus package to help reduce the impacts of inflation on energy prices. This is the 3rd or 4th package now. I've lost count. They're calling this the defensive shield. They are instituting a gas price break by cutting sales tax on fuel from 19% to 7%. They plan to run these cuts through 2024 with expanded electricity subsidies and funding for nuclear plants. The problem here is, you have to think about this. Europe has to rebuild their electrical infrastructure and their natural gas infrastructure because of Russia. So it's not just, oh no, we have an interruption, prices are going up. It's the fact that we have to spend money on infrastructure, which is stimulative. Remember, when we stimulate or want to stimulate, what do? We spend money on stuff. We give people jobs. We build bridges and highways, nuclear power plants, whatever. Look at what China's doing. They're trying to stimulate. What do? They started 53,000 infrastructure projects in 2022 here, this year alone, year to date. That's supposed to be stimulative. But the problem is when you have inflation at 11% and you're stimulating, all you're gonna do, even if you need to do it because you need energy independence, you can't rely on Russia anymore, all you're gonna do is make inflation worse for longer. So to me, this 200 billion euro stimulus package and an energy package in Europe on top of basically 11% inflation, following a $65 billion euro package and following 2 more packages before that, to me sounds a lot like Nancy Pelosi going, we need a $3 trillion infrastructure and stimulus plan because package 1, 2, 3, 3.5, and 4 weren't enough. It's crazy, and it's very stimulative. And unfortunately, that just means more inflation for longer. And that means our economy at the same time continues to suffer. GDP this morning came in at an annualized decline of negative 0.6%. That was the expectation. We thought it was going to decline at negative 0.6%, and it did. So anybody who says we're not in a recession at this point apparently isn't paying attention to the technical definition of a recession, which means Q1 negative, Q2 negative. Unless we revise those higher, Q3 is probably going to be negative as well. We're potentially going to walk into a depression when we have a recession in excess of 4 to 6 quarters in a row. We're on 3. And so even though you have folks over at the Fed going, no, we don't think we're in a recession yet. Sure, the odds of a recession have heightened, but we don't think there's a recession yet. I think they're smoking crack. And they're using this idea of, oh, there's no recession yet, as an excuse to be more aggressive and fight inflation. Except now they've changed the definition via their Great Reset again. They don't care even anymore about just inflation. They still don't even know how they want to measure inflation, but they don't even care so much about inflation right now. What they care about right now is crushing jobs. They want to see unemployment go up, and they want to see job openings go down, because that, in their opinion, is going to actually be the conduit to get inflation down. And that's because their other methods of getting inflation down haven't worked yet. The problem with that is, what happened this morning? Well, we got another terrible jobs report. And when I mean terrible jobs report, it was actually a really good jobs report. Instead of the expectation of 215,000 people losing their jobs, 193,000 people lost their jobs. That's a lot less than expected. It's 22,000 fewer jobs lost than expected, or claims than expected. Now, the Fed looks at that and says, oh, labor's still strong, let's hike more. In fact, James Bullard's quotes this morning were literally, unemployment claims came in super low. That was his quote, and says that the job market is extremely strong. Look, they right now do not want anything to be super good or extremely strong. They're gonna crush jobs. That's their goal right now. And they're gonna crush jobs at the same time as having crushing interest rates and at the same time as conducting quantitative tightening. The effects of quantitative tightening, by the way, we have not even yet seen. Quantitative tightening just began in May. And quantitative tightening is terrible because really what quantitative tightening does is it means the Federal Reserve is going to purchase fewer bonds. They're going to let bonds mature. When bonds mature and they don't rebuy them, what ends up happening is we have less demand for bonds, which pushes down prices for bonds and drives up yields. That process is just beginning. This is the opposite of what we used to have, where we were just buying as many bonds as possible and keeping yields low. And really the problem with this is we have a lot of debt as a country. So the more debt we have and the higher interest rates go and the higher we have to sort of re-amortize some of this debt that we're not rolling off because we're not going to let everything roll off, the more expensive it is for us to actually operate, which means the less revenues the United States or other countries end up having to do other things, which ultimately means a weaker economy again. So all of these things are converging in a terrible way. High interest rates, high bond yields, less revenue for the government, an earnings recession because sentiment is down and fear is down, while at the same time you have countries who can't get their act together, like the United Kingdom, who are like, are we stimulating or not? Oh well, we're on the edge of margin calls and pension funds going bankrupt. Turn the money printers on. And oh no, we're only going to do that for 2 weeks because that's bad. We don't want to cause more inflation when the Eurozone is basically at 10% plus inflation. This is exhausting and it's really scary. And so a lot of folks are wondering, like, Kevin, what do you do? Like, what do you do in this kind of environment? Because we know that real estate is going to get crushed. That's why I'm creating my startup house hack, not to go buy real estate right now, but to go bottom feed. So we're going to raise money for the next few months here. We'll have deadlines at the end of each month for people who want to invest, and we're going to try to bring on non-accredited investors as well. Probably a minimum investment of somewhere around $15,000, but we'll try to open that up to non-accredited investors who have $15K to invest. And our goal will be to bottom feed in real estate, but there is no rush. We are probably going to be in these doldrums for years. And so that does beg the question of, does it make sense to sit in the market? Well, let me give you the only piece of good news. The only piece of good news that we have right now. I hate to say it, but this is it. There's no other good news. The earnings season's gonna suck. I mean, sure, you could get life insurance in as little as 5 minutes by going to mettkevin.com/life. You could get a free Bank of America stock by going to the link down below. You know, you can take advantage of the coupon code before it expires tomorrow. But there's only one piece of good news. That's it. And in my opinion, this is the only reason you would want to hodl your stocks. And it's not financial advice, even though I've passed my test to be a financial advisor and I'm becoming a registered financial advisor and I'm opening an investment advisory firm for some products that we're launching, which are going to be pretty awesome. It's 3 ETFs. I can't give you financial advice. I can't solicit you to invest in HouseHack. The PPM has to do that at househack.com. I can't give you any guarantees. But this is what's giving me the only semblance of hope to stay in the market. You ready for this? This is it. This is it. This is it. This is a chart of the 5-year break-even index of what we expect inflation will do. Unfortunately, this lags. It lags by about 4 months. There's a 4-month lag for this. I hate to say it, but it's going to be painful until we actually start seeing the 5-year break-even expectations for inflation manifest in actual inflation. We're going to keep having pain. We need to see inflation meaningfully come down because I don't believe the Fed is actually going to be capable of getting jobs down. I don't actually think they're going to get the unemployment rate to rise that much because the economy underlying, even though it's going to look like a recession because we're going to grow less than we did in prior years, which makes sense because we're coming off a freaking bubble, I don't know that we're going to get the unemployment goals the Fed wants. And so that means we're going to keep having pain until the inflation rate actually comes down. And the inflation expectations are presently, and this is good news, at literally the lowest level we have seen in more than a year. It doesn't get any lower than this. It does not get any lower than this over the last year, which is good. It's good that inflation expectations are going straight down. But unfortunately, guess what the Fed told us during the last Fed meeting? What did Jerome Powell tell us? In my opinion, nobody studies the Federal Reserve more than I do. But then again, I'm not trying to like pat myself on the back here. I just dream about the Fed. Jay Powell and me, we go back, okay? He's my daddy. Jerome Powell told us in the last meeting that inflation expectations are actually good. They're a check mark. But what's more important right now is jobs. So he's throwing cold water on this chart because he says they got to see job openings come down, which sucks. But if this chart comes true, they'll flip-flop back. If we actually get inflation to plummet over the next 6 months, they will flip-flop. They will talk hard right now until the numbers come down, but they will flip-flop when inflation comes down. The problem is, how long is that going to take? Is it going to be 6 months? Is it going to be a year? Is inflation going to plummet to 5% and then sit there for 2 years? That would be bad too, right? These inflation expectations could imply that inflation is going to plummet to 5% really quickly. But what if it sits there and flatlines for a year? Well, then we have to deal with an aggressive Fed for a very long period of time. Which again, at the moment, is terrible for stocks, but will also crush real estate. The high 10-year treasury, with mortgage rates now averaging over 6.7%, and mortgage rates, if you Google mortgage rates, coming in for a credit score of 740, of 7.55% per Google now, even though the average is 6.7. The leading indicators are suggesting 7.5% is what we would expect for mortgage rates. The real estate market's gonna get crushed. They're gonna crush our wealth. They will crush our wealth through stocks and real estate, and hopefully inflation comes down. That'll create opportunities to buy real estate, and if you can't do it at scale, I'll do it with you at HouseHack. But we have to go through a lot of pain, and it sucks. Thanks for watching. If you found this helpful, consider subscribing, and good luck out there.